Hello and welcome to the final episode of this special series, Get Started in the Market, where we help you understand the basics of stock market investments. In case you missed our last episode, here is a quick recap of all that we covered. Let's start today's episode with the different kind of trading orders that you can use while deciding to buy or sell in the stock market.
A market order is when you put in a buy or a sell order and it gets executed immediately. The risk of using this option is that the price that you last saw and decided to put in your order and the price at which the order actually goes through might vary. But what do you do if you want to buy a stock only at a specific predetermined price? In this case, you will use the option of a limit order. Let's understand how this works with an example. Supposing you want to buy one share of TCS at a predetermined price of 2,450 rupees, but the current market price of TCS is 2,500 rupees. So what will you do? You will ask your broker to put in your order with a limit price of 2,450 rupees. So if and when the stock touches this price, your order will get executed. You can use a similar order when you want to sell a stock by putting a stop loss. Within 24 hours of your trade, you should receive a contract note from your broker like this one. These contract notes are usually in a digital form. Always ensure that this contract note is signed by an authorized signatory.
In case there is any discrepancy or if the shares that you have bought or sold are not reflecting in your demat account but the money has been debited, approach your broker immediately. This has to be done within 10 days from the transaction date. In case the broker does not give you a satisfactory response, approach the investor cell of the stock exchange within 15 days from the transaction date. So by now, we've told you how to buy and sell in the stock market and how to manage the various risks you might face while investing. But how do you decide what you want to buy and what you want to sell? That's what we are going to take you through today. The very basics of how to value the price of stocks and how to judge the current and future growth of companies that you want to invest in. An introduction to what is popularly known as the fundamental analysis of the stock market.
Fundamental analysis of a stock can simply be viewed as an extensive health check of the company. It's a 360-degree check on various parameters, be it the financials, the quality of its management, or the overall economy and the industry conditions that might impact the performance of this company. So let's start by understanding some of the popularly used financial ratios to judge the health of a company. One of the first things you should focus on is the earnings performance of a company. How has the company delivered on earnings over the past few years? And what are its earnings expectations over the next few years? You can measure a company's profitability by looking at its earnings per share or EPS. This is calculated by taking the profit and simply dividing it by the number of outstanding shares in the market. For example, if company A has earned 100 crore rupees as profits and has 10 crore outstanding shares, the earnings per share of this company will be 10. Now let's take this example forward and use the EPS to compare two companies. Suppose company B has earned 200 crore rupees as profits and has 50 crore outstanding shares. The earnings per share of this company will be just 4. Hence, though the profits of company B are double that of company A will still be seen as a stronger company based on its earnings per share.
Earning per share is, I think, one of the basic parameters based on which you choose to pick up a particular stock to invest in. And generally, we check as to how the stock has been performing. Has the EPS been growing year on year? Because you could possibly have the profits growing, but at the same time, in case the equity base also is growing along with it at the same time, then the EPS does not grow. So based on that, the stock price also may not really move. So, looking at the EPS growth year on year is very, very important.
Another financial ratio commonly used to judge the valuation of a stock is the price to earnings or the PE ratio. This gives an indication of what price the market is willing to pay for the company's earnings. And this is calculated by dividing the price of the stock with its earnings per share. So let's take our previous example forward. Suppose that the stock price of both company A and B is 500 rupees and we need to compare the PE ratio of these companies. This is what we would do. We will divide the current price, that is 500 rupees, with their respective EPS. We get the PE for company A as 50 and company B as 125, which basically means that for every 1 rupee of earnings, the market is paying 50 rupees, and for every 1 rupee of company B's earnings, the market is paying 125 rupees. A high PE usually indicates that the investors are expecting higher earnings in the future. However, a stock with a lower PE but higher earnings visibility is considered a better investment.
I think clearly what the ratio suggests is the market price and the EPS, and that's basically what the ratio is all about. The importance of the ratio in absence of capital appreciation works out the way that it is the kind of number of years or the time period that will take a shareholder or an investor for him to return or get his principal back while investing into the company. So again, I think price earnings ratio is a very important tool when you're doing financial analysis of companies. It is very important to have a peer comparison when you're looking at PE ratios. The general thumb rule is that the lower the PE, I think the better valuation the company derives, and in that sense I think a better multiple. But I think it is not applicable for all companies. I think you should also be looking at a lot more ratios along with the price to earnings.
Price to book is another financial ratio that is used extensively for fundamental analysis. To understand how this ratio is calculated, let's first understand the meaning of book value. Book value is the total value of a company's assets that the shareholders would theoretically receive if a company were to close down. And if you divide the total book value with the total number of outstanding shares in the market, it would give you the book value per share. If this value is closer to the current market price of a stock, it indicates that the stock is underpriced according to this parameter. And if you divide the current market price with the book value per share, it would give you the price to book value or the PB ratio. And in this case, the ratio is below 1. It is considered as value investing.
Price to book is something where you try and find out as to which stocks are available at a discount. But again, this cannot be looked at in isolation. This could be one of the parameters to look at a particular stock. And this is very important, especially in terms of financial services or banks, where price to book is very, very important. When it comes to manufacturing sector, the importance actually reduces.
Debt is often perceived as a negative word in our personal lives. But not all debt is bad when it comes to companies and economies. Companies need to take on loans and debt to finance their businesses, especially the companies that operate in capital-intensive sectors like infrastructure and auto. But that does not mean a company should over-leverage themselves, or in simple words, take on more debt that they can afford to pay off from the returns they expect from their investments. Hence, businesses balance the use of debt and equity to keep the average cost of capital at its minimum. And we can assess if a company is using its debt smartly by its debt to equity ratio. This is done by dividing a company's total liabilities by its total equity. A debt equity ratio of around 1 will mean that its liabilities equal equity.
Capital-intensive industries which have huge amounts of debt onto their books, both in terms of long-term borrowings and short-term borrowings, because a lot of money will get invested in setting up plants. For example, I think power plants, cement plants, I think a lot of capital employed or capital expenditure happens in setting up these plants, and they have to borrow a lot of debt. When it comes to the short-term borrowings, I think a lot of working capital requirements are created for a lot of these manufacturing companies for continuing their working capital needs. So debt equity ratio becomes an important integral component while judging the leverage positions of companies. And excessive debt to equity ratio is not suitable, because I think the kind of interest servicing that you'll do on the debt will have an impact on your profitability, and therefore lower margins and lower profit after tax, and a corresponding cascading effect then happens on your EPS, where I think the earnings per share that has meted out to shareholders in form of dividends are also very minimal.
The last financial ratio that we will focus on is return on equity, also called the ROE. This ratio measures a company's profitability by showing how much profit a company generates with the money shareholders have invested, and is calculated by dividing the net income of a company with its total shareholder equity, and is expressed in percentage terms. Higher the return on equity, the better it is. Companies with a high return on equity are looked at as efficient.
Return on equity is basically the profits divided by the shareholders' equity. And this actually shows you as to what is the return on the investments made by the equity shareholders. So in case the return is say less than 10%, then you generally say that it's not really worth looking at the particular company, because you can get a much better return on your investment from possibly a fixed return sort of a instrument. So it doesn't really make sense investing in those companies. But at the same time, generally, you look at companies giving you a ROE of say 15% plus. Typically, a 20% is an excellent sort of a ROE, and that's where you tend to invest in.
Now that you know how to buy stocks, it's time to introduce you to some exit strategies. But that's after a quick break. Stay tuned.